Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, August 5th, 2024. So it's 4:05 p.m. Eastern Time. Markets are now closed, and I just wanted to do a closing market wrap. We ended the day above where we started out today, where I sent out a couple posts and then reiterated those hard, what I call all in long for me. That's just me, doesn't have to be you. The reasons why still stand. In fact, they've been further supported. We had a red close today, but well off the lows. Remember, it was this morning pre market. I got those posts out to you. So we recouped a good part, not all, but a good part of today's losses. But most importantly to me is where we close. So I'm going to say this very succinctly. There are no guarantees. There's no guarantees the market won't continue to melt down hard or even outright crash. One guarantee I can give you is this was a very objective level to buy today, and we closed on objective levels to keep me long. And again, as I mentioned this morning, it's not just I'm looking for a 2-3%. This could have a little more teeth to it. Now, with that being said, again, so what I can guarantee, even though I can't guarantee where we go from here, if these levels hold, I can guarantee it's objective here because we closed at key support levels, and that's all I'm going to do. I'm going to go over those support levels, show you where they're at. Again, the narrative that you're most certainly likely to hear from the cheerleading squad on TV is that and it is baked in the cake. By the way, I told you a rate cut was baked in the cake. And remember yesterday, to my surprise, when I went in there before today's big drop, it was up to, we went from, a quarter point hopeful, kind of favored at the September meeting to a 50-point baked in the cake. And somebody mentioned, I have not turned on Bubble TV today. Don't plan to. I don't feel like throwing up in my mouth today listening, these Johnny come lately that the market's going to go lower. They're going to march out the token bear, perma bear, as they always do in these days. But then you're going to get the same folks that tell you to buy no matter what happens. Again, guys, if you don't know what to do, and somebody made that comment today, just all you can do in these periods is trade off the technicals. Fundamentals are changing too rapidly. I just got a news headline: Google lost that antitrust case on their search engine. But these things are all. A lot of things are priced in, a lot of things aren't. And the bottom line is, folks that try to figure out the market based on fundamentals, what it should be doing based on any fundamental analysis in times like this, you're going to get your head chopped off. Technicals are by far the best guide in volatile markets. They shine in periods like this. There is no guaranteed thing. There is no 100% anything. All I can tell you with certainty is today, on the 200-day moving averages, where we parked the indexes, many stocks, was an objective level to go long. Let's not forget that besides the narrative that they're going to start, the market's going to soon turn its focus to the rate cuts, is the fact that we have the biggest buybacks in the history of the financial markets ever, bar none, no close second, with Apple, Microsoft, all these companies announcing huge buybacks, committing capital. And so we'll talk about that. If they're not going to buy here at the 200 days, and they were planning to buy, 10, 20% higher on some of these companies, where on God's green earth are they going to deploy that capital? So you're going to see that. Now, again, buying from Apple and Alphabet and NVIDIA for these share buybacks, that can be offset by massive selling. Remember those stocks, that big tech trade, the AI bubble, was a very overcrowded, overloved, overbought trade. So, at the end of the day, if CalPERS and New York, I just read yesterday, it was one of the world's biggest pension funds in the country had loaded up on what was that stock that caused the market crash, the computer crashes the other day with the crowdsource. And of course, they loaded up on that last quarter, right before the stock had that, right before they got killed based on that. There was all lawsuits piling up. Delta lost all the money, and they're going to sue them, and a lot of people are. Anyway, so my point is that those things are still here, and they're going to happen. They're down the road. They could happen any day where you get, I think it'll take some more downside in the market before you start hearing about the first major pension fund that needs a bailout, and then talks with the election coming up. Oh yeah, that'll be a political hot button for sure. Whether we make it through before or after the election, bailing out these pension funds that were mismanaged, took too much risk, and but you can't let and I get it. It's a touchy subject. So let's get away from that. That's all. Those things will play out over time. Sometimes, my point is, sometimes they play out much more rapidly. That, like I said, these things don't matter. I've been saying this for last couple months. All these overbought conditions, breadth of deterioration, my low volume indicator firing, my Hindenburg indicator for the Nasdaq firing, and probably about 10 other things that I've said I've never seen so many things come together to bring the risk for a sudden and swift market drop this high in decades. And so, but like I said, they don't matter until they matter. So we got to believe what I'm getting at here. You got to stay flexible. Just because this is an objective level to be long, cover shorts, where the market should, quote unquote, with my little air quote fingers, should bounce, doesn't mean it has to, okay? That's all. I'm just getting that out there. But now we can see an 85%. Let me see if I refreshed this before I pulled it up. That was earlier today. I pulled it up. Yeah, 85% chance now of a 50 basis point, or that will be at 50. Somebody mentioned that they paraded out, Jeremy Siegel or somebody, crying for an emergency rate cut. It's not a great idea. The Fed should just talk it up and kind of affirm through their mouthpieces that they, go around and parade around in between the meetings and talk the rate cut up, kind of solidify it with rhetoric. Emergency rate cuts do not have a good track record. If you look back, I can remember one I posted when same thing, go back 2 months ago when everybody was bullish and we had an emergency rate cut. I cited this back in 2008, right after the market had peaked, and I said, we're going a lot lower, bear market, in a forum, and cited a article from the Wall Street Journal in, I think it was in March, it was in 2001, we had an emergency 50 basis point rate cut. Market had the biggest one-day gain in years, if not decades, actually, possibly in history from that. And then 6 months later it was down like 70% or something. In other words, you'll get that if you got an emergency rate cut. That's something you might want to sell in, because emergency rate cuts will be implied immediately by kind of the dumb money, if you will. Oh, super bullish. And then the smart money is going to say, oh, there's something else. What does the Fed know? What broke? What mutual fund? What money market fund? What brokerage company? What financial institution is broken? What does the Fed see that we don't? So you kind of don't want an emergency rate cut. You want it if you're long and it happens, sell into it if you get the pop. Again, we'll cover that if we get it. I just want to say that's a sharp increase just since last Wednesday. If you guys remember, if you watch Powell repeatedly telling the press, as they ask the question, absolutely not. We have not made any decision. We have no plans to cut at the September meeting. He will not ever go against an 80 market betting an 85% chance. The market has already thrown a hissy fit. Now they didn't get one, a week ago. And mark my words, he's going to give the market what it wants. They also said that he also says they're apolitical. Yeah, right. All right. Anyways, that's that, guys. I just want to mention that's baked in the cake. So where might, despite the recent, bloodbath, which again, said it before, once we took this level out, once we took out T1, that's where you'd see the selling accelerate. So it was a relatively contained drop down to T1. We bounce, and then there was an opportunity for one last hurrah there. We didn't, but that's when we took it out, it happens quick. And that's exactly as, predicted in advance, that once we got down to that point, took that out, you would see the selling begin to accelerate. That's accelerated selling. However, and look, we've got a lot of momentum. We may come down. I'll tell you right now, I'm not going to call it coin toss odds, or I wouldn't be, as heavy long, that we're going to bounce from here on the 200s. But I'd say it's certainly not super high probability. It's not 80-90%. We could easily go down to that next target there, which is, again, about 413. Sometimes you overshoot the 200s. Quite often, in fact, you overshoot the 200s, as I mentioned in previous videos and showed you, by a day or two. Usually it's not much more than a few days. Sometimes I've seen it up to a week before you come back to them. But and it does happen, but in very few occasions do you just go right on through there and not look back after such a strong bull trend. So that's it, guys. That's and I wanted to, as I'm doing this video, just kind of highlight the levels that we parked on. So remember, off today's lows, we reversed. This is the close of today's candle. If you don't know how to read these red candles, the way I have them set is the body, the fat part. The top is going to show you today's close. You can see I have the, oh no, I don't. I have after hours trades turned off. We're drifting a little higher since the close, but just to show you where we parked the close, that's most important to me, is right here, right above both the 200 simple, the blue one. Here, I'll turn off everything for you. There's the 200-day simple moving average and the 200 exponential in red, and there's our close right above it. So check for QQQ, that this is simply a test. Remember, on a daily chart, I say this very often, I say this all the time, all that matters when you're trading on a specific time frame, if you're an active trader and you're trading off 5-minute charts, the 5-minute candlestick close matters. If you're a long-term swing trend trader and you're trading off the weekly charts or using that for your buy and sell signals, you have to wait till Friday 4 p.m. for the weekly candle to finalize. So this is the daily candle, and if you put a line chart, that's where the line's going to be right there. I'm obviously using candlesticks, but the line chart shows you the close for the day. And that was it. So we came down today, tested the 200s. And let me show you something before I get to all the S&P, the market leaders. I always say that the closest thing to the stock market, remember that the NASDAQ 100 is most certainly not the stock market. It is an index, but it's not representative at all of the overall U.S. economy. It's sorry, I had a little phone call there. It's not representative of the U.S. economy, the NASDAQ 100, that is. It's representative of a handful of the world's largest companies, mostly technology-related companies, the Mag 7. The S&P, closer, but it's not at all the stock market. It is the 500 largest companies in the U.S. by market cap. So again, there are many times more mid and small caps out there. So the closest thing you have is the Wilshire 5000, which this one tries to track something similar. The VTI, Vanguard Total Stock Index Market ETF. So it has, as the description, if you look it up, says it's Vanguard Total Stock Market ETF seeks to track the investment performance of the CRSP U.S. Total Market Index, which represents approximately 100% of the investable U.S. stock market. And it includes large, mid, small, and micro cap stocks regularly traded on the NYSE and NASDAQ. So there it is. So that's what it's doing. And I measured it today, and we were down a whopping 10%, almost to the button. You can see on my measuring on the pop-up box to the left. 10% is a run-of-the-mill correction. It's the old, been there forever definition of a correction, a drop of 10% or more. And so, and where I'm going with this, check out this headline I got today. Subscribe to the journal. I'll push you emails and on the headlines. And I'm trying to zoom it. I'll read it for you if you can't read it on there. I did not click this link, nor do I even care to. Is this 1987 all over again? What's driving the market meltdown? Good God, guys, we dropped 10% off the highs, and they're going to compare this to 1987 where the Dow fell 20-something% in a single day? No, the stock market is down 10% off the highs. And so look, is it ugly if you're long and got caught in that mess? Of course, but it's not 1987. And so when I see things like that, it just shows the fear mongering it is up there. And Warren Buffett said it himself. I talked about him being a good fundamental investor, obviously one of the best greats, but he has a lot of sayings out there. One of those is, you want to buy when there's blood in the streets. Well, look, this correction, this bear market has only just begun, in my opinion, but there's blood in the streets right now. Do you want to be shorting a day like today, or do you want to be covering shorts and going long? So that's up to you. So there, and look at VTI, perfect kiss of the 200-day 200-day exponential moving average. You can see it's done a great job in a bull trend. You're above it, and you should buy pullbacks to it. And there's a case where you hit it, you bounce, you went through for a little bit, came on. Well, that's when we took it back there. But when you rallied into it, rallied into it, rallied into it, those were great shorting ops once you clearly took it out. So when you're down below it, and at some point we're going to be down below, and I believe some point this year, and we're going to be shorting rallies back to it, or at least looking for that if it aligns with other reasons to short it. You know, just short it, and it's just like, with support and resistance levels. I always tell you, you have to take a side. If you're bearish and you're a bear and something's going down to support, well, you wait for that support to break and then you initiate a short position. That's your plan. Whereas bulls are looking for that to go long and buy a pullback to that support level. Whereas, again, somebody bearish expecting that support to break won't go long because you're probably going to get stopped out. So that's why I criticize those people that say they're completely agnostic traders. Just trade the charts, trade what's in front of you. You got to have a bias to where things are going to know, in that example, do you buy a pullback to support, or do you hold off on the buying it and instead wait for it to break to short it? Likewise, when you're in an uptrend, you sell rallies into resistance, or do you hold off and wait for a breakout above that resistance level to add to your position? So anyways, I wanted to summarize that this is another key index, really the stock market, falling to the S&P 5, falling to the 200-day moving average. Here's the S&P 500. Came a little shy, and I'd say I'd like it better, so maybe this week. Look, as we go down tomorrow's another red day. You're going to have the S&P coming in here. You're going to have other stocks and key sectors going in there, and it might be the NASDAQ may be the one punching through a little bit, just like back here it was the S&P 500. This was in November last year. Remember, the markets bottomed here in October. We had a little sloppy trading through it. There was a lot of grinding around, but once we clearly took back the 200s, they bought the first pullback to it, to the simple right here, then undercut through it at the very same time. QQQ, however, see, the QQQ traders were ruling the roost. Everybody wanted big tech. It was all, the rally, especially at this point in time, was all about the Magnificent Seven. So it didn't matter what the S&P 500 was doing. That's also why I'm putting a bigger weighting on the NASDAQ 100 hitting at this time, because if you don't think this drop is all about the Magnificent Seven, those leading tech stocks, then I don't know what to tell you, because obviously it was. We can see how far they've dropped, how much they've outperformed to the downside. And that's why I've been favoring short the NASDAQ 100 versus the S&P 500. And to quantify it for you, down to the targets over today, that's a 16% drop off the highs. And Grandma's Index, which is the S&P 500, because it's chock full of steady Eddie dividend-paying stocks, defensive issue, down 9.65, not even a full 10%. So that's a big outperformance. And so part of trading too is about knowing which indexes or sectors to be trading in. We'll get to the sectors here. Let's do that now. Let's just jump over. Let's start with the market leaders. Let's go back to, we'll just stick with this daily time frame for now. Put on some levels. Apple closed, as I covered earlier in the video. Key support right here, those previous double top highs, massive breakout right there, which validates this as an important technical level. Pulled back to there. Apple with one of the biggest buybacks in history. So again, if you are in charge of Apple's buyback program, now they do not disclose their buy parameters. When do they buy? But if you've got all this cash to buy your stock back, and you weren't buying up here when it was, let's see, a total of, about 16% higher, when do you buy? So you have to imagine they're going to come in. And look, if they don't buy it here at 198 support, you got the 200s below, and you've got other support levels. Ultimately, after there's a pop or not, whether we pop first or not, an Apple in the market, this is where I'll be looking most likely to cover some shorts and go long again down here at the bottom of this range. So if you will, let me do this for you, just so you know how, what I see when I look at Apple. I see a massive trading range here, right there. Break out to new all-time highs, followed by simply by a back test. So if you were bullish back here, or you're bullish now, or you're whatever, you're just looking for a stock. This is a textbook entry on a stock. Now, again, there's some ugly price action in the market. Maybe something's going to break. Maybe we go a lot lower. What I started the video telling you is all I can do is promise you can't promise you where the market or Apple or anything's going, but I can promise you this is an objective long entry. A 16 something percent drop after a bullish breakout, textbook breakout, a back test. If you miss the breakout, the back test is your most objective and next objective entry. Now, if and when the breakout fails, which I suspect it will, whether it happens now or down the road, once it solidly comes back into this range, the next stop's probably going to be the bottom and then down through there, because that's going to be very bearish. Why? Because as I often say, fewer things in trading are more bearish than a failed breakout. That's the breakout. This is a back test. If the breakout fails, that should be the first stop. But the fact that it does, if and when it has failed, then that's bearish. That's probably going to be the catalyst to send Apple much lower to my longer term price targets. But as of now, all I can tell you today, again, I can't tell you if and when that's going to happen for sure. I can tell you we closed right on support. All right. And Apple's got a lot of money to buy their stock back. So if I was in charge of their stock back, well, no, let's not even go there, because my downside targets are too bearish to buy anything. But if they have to deploy it, and if you're a trader, then yeah, it'd probably bounce here. Microsoft, this is a busy chart, just an ugly chart, breakdown, back test, well below the primary uptrend line. I'm talking the trend line that goes all the way back here to the January 2023 lows right there. I've covered this many times. We closed at support level I've had on here for a while, 387.50. We closed right on it, but we're below the 200s, but still within close enough proximity. Remember what I said in today's earlier video. You're not going to see all 7 of the Mag 7 stocks fall to hit their 200s all at the same time on the same day and all park there or reverse on. So some are going to have to get there first and go through, and then maybe come back test, go up. And others are still a little above those, like Apple, for example, still above the 200. It's been stronger. NVIDIA still above the 200 days, but this is a target I've had forever and a day, and I've been very strong on reiterating that we're going to come and visit this trend line soon. We shorted it there. We had short entry there. Boom, we hit it today, and that is a 10, or close to a 10 on a scale 1 to 10 for support. It's obvious, clean, well-defined, no violations, multiple reactions, trend lines. So, and this is a crowd favorite. So again, like I said, if you liked it at 140, how can you not love it at 96, right, or 95 or whatever? Now, do we go lower? Of course. I think that's the targets I gave you back at the end of June. I'm calling it down here with a potential deeper target, but still calling for a 77% drop off the recent highs. We hit my first target today, which I said back then when I gave you these targets, if we were to hit it, it'd be a 30% drop off the highs. So we got that, and we parked right above it. So there's NVIDIA. Now let's cover the rest. I'll get to a few sectors, then we'll wrap this video up. Alphabet is a busy chart, but let me just take off all the lines and show you Alphabet hit and pretty much parked right above the 200-day exponential moving average. You can see they bought it here when the simple and exponential 200s came in together. They bought the 200 exponential there. Once it took out the intersecting 200 simple and 200 exponential, it back tested. So you can see again, because of the oversold conditions right now in the market, in Alphabet, the fact that it took 20% to get there says it's probably at this point, that's a pretty good correction. The buyers will probably step in soon. So hence, again, the reason for looking, I'll sharpen my pencil with bounce targets and all this stuff. It's all collective, how they all look at the same time. Amazon, just nothing but ugly. That took out the 200s, hasn't looked back, closed below them there. Like I told you in today's earlier video, one of my least favorite of the Mag 7 stocks. Meta closed on that 456.08 support I've been talking about recently, which is the top of this huge gap right here, comes across bottom of this gap here, support there, and so it keeps holding that support. Over time, going a lot lower. Market could crash tomorrow. I don't know. I just don't think so. Again, I think the odds favor them stepping in here. All right, let's take this thing home with a few sectors. XLK tech sector. Busy board, but to summarize it for you, everything I've been covering for weeks now. We had a divergent high, negative divergence, and a big fat bearish engulfing candle. Then you had, if you missed that, you had a trend line break there, a little wedge. And the tech sector, which is the heaviest component of the NASDAQ 100 and S&P 500, is down 20%, right to uptrend line support. It's this uptrend line. If you draw a trend line off that's the lows right here, October of 2022, for after that bear market that we had heading into it. Beautiful. Well, not as beautiful. You have two distinct reactions there, and one more here. So I recently added this trend line here. We are below the 200s. But we rallied back up to get in close proximity to them today. XLV healthcare sector, just fresh off a breakdown, a lot more downside to come. So look, guys, I'm not getting longer term bullish. I'm not even looking. I can't write off new highs as a possibility. It's not my preferred scenario, but I'm just kind of taking this one day at a time right now. And I'll let you know. We'll be, definitely, if we do get a bounce here, whether we get a bounce or not, guys. If we go a little lower in the rest of these stocks and sectors like this, the financials want to hit their 200s, want to hit the next support levels. My next support levels on QQQ and SPY, if they want to get hit, then we'll just be looking there. I got in too early. That's what I tend to do quite often. I'd rather get in a little early than a little late. Because if you get in late, especially when you're shorting or when you're going long, let's not forget, bullish and long and strong right off the January lows right here. And if you missed it, and I know some didn't, I remember the posts right then, Apple, Amazon being my favorite overweight, that we had just a not let you back in. We had one little corrective wave there, but it was just all ups off from the beginning of the year. When I flipped to covering shorts from right here, we came into the end of 2022 short and went long right in the beginning on January 4th, I think it was. And so what my point is, same thing here. Most don't want to short here. They don't want to short the bearish engulfings. Why? Because the last couple didn't work. They don't want to short the trend line breaks. Why? Because the last couple only proved to be short-term pullbacks. And then what happens is things happen very fast. And so, most don't want to buy today. Blood in the streets. That's why, they have that saying. But that's typically when you want to be buying. So that's financials. Oh, and let me just get to that. So we had a trend line here that was broken today in the financials. Look, these guys are ugly, and I don't, like I said, I'm not married to any bounce here or any bullish scenario in May, and it could be this week. May flip back to bearish. I think if I start seeing signs the market's going to just have a complete meltdown crash and go another 10% more before it rallies, I will definitely be out of my longs and hopefully find an objective level to get back into my shorts. Otherwise, I'll wait patiently for the next objective entry. But this one, divergent high, breakdown of the minor trend line, breakdown of the secondary trend line today, but we parked. I can add a level right here. It's either way, the financials have just rolled over. There's JP Morgan. I highlighted this one recently. Played the game on earnings. If you guys remember, the banks are the first to report in earnings season. And I played the earnings game, and I said it's not the day of or the day after earnings. I said the trend coming out. And JP Morgan showed you we had a divergent high here and a nice clean trend line. Called this one down post earnings. And so far, it's been a nothing but red sticks for the last four trading sessions, down about 12% or so. Visa, MasterCard, they're already in downtrends. They're moving lower. I've used these in my kind of leading economic indicators. Why, if the market was so hunky-dory, as everyone was telling us up until the last few days, the economy was solid, the consumer was solid, the jobs market was solid, why were paychecks, ADP, MasterCard, Visa, the transportation sectors, why were all of my leading indicators rolling over? The stock indicators, there's also economic indicators, but the companies that if the consumer's spending a lot of money, then Visa and MasterCard are making a lot of money, right? If jobs numbers were really as good as they said, the BS numbers, not BLS, the BS numbers up until recently, then why were paychecks and ADP peaked over a year ago? Why were they in solid downtrends? And so those were the things that weren't jiving with the narrative that was being fed to the public about how strong the jobs market was. And now look what happens, because So the evidence is becoming clear based on the flawed birth death model and the way the government calculates that things are not hunky dory. So um, I'm just showing you a few others that I wanted to show you. So I called Bank America down, if you recall, the other day at earnings. I can't remember if that's earnings candle or not. If it was, it's a great example of what I said. It's don't worry about the day or two after earnings. It's the trend coming following. Called this one down post earnings in advance because of the negative divergences. There was a trend line break. Was also a shorting up, and look at that, down since earnings or since the recent highs, down 20%, 21%, and look where it hit today. So that's it. So if you took it as a short, you just hit the 200-day moving average. It's a good level to step in and buy. Over time, do I think it's going a lot lower? Yeah, but it went from, look at this. You don't see this often, guys. Down here, look at the RSI. And this is Bank America. This is some little piddly regional bank. You went from deeply overbought. You had about an 80 level on the RSI, an extreme overbought, about as overbought as the stock ever gets, down to oversold in one fell swoop on the daily RSI. That doesn't happen often. And so it kind of shows you the nature of this market and the hot air that was in here. And so anyway, hopefully, even if you didn't profit on the short, hopefully you didn't buy the earnings and chase it. Based on the technical posture. Berkshire, I wanted to point this one out because I got an alert today. I told you my alerts would be going off like popcorn once the turn came, and they have been. But I didn't short it. It took out intraday this primary uptrend line off the October 2022 lows. Remember, that was the low. This is your bull market uptrend line, parked right on it after an intraday undercut. And based on the scope of this divergence, all that, I think this trend line does go. It could go tomorrow or it could go 3 weeks from now. But either way, all I can tell you definitively, and I'm sounding like a broken record, but that's the point of it, support is support until unless broken. So we hit support today. And if it breaks that level anytime soon, it's got really big support here. A lot like Apple and other things, you have these trading ranges. These, to me, they were, we'll all see what we want to see. I see like a topping pattern and then a breakout, which clearly has now proved to be a false breakout, right? Because this is like that Apple chart I just showed you in almost exactly. You had that multi-month, very clear, well-defined sideways trading range with previous double top highs. You had a breakout, but not just a breakout. You had a very impulsive breakout, strong buying on it, and to put in a divergent high, just like Apple. This is where Apple is now. Apple can do this. And when it does that, that's bearish. So this one, the breakout failed. However, you hit uptrend line support. So maybe a little jog up, maybe backfill this gap, maybe a little more, maybe not. Either way, a break of the bottom of that range is going to be uber bearish. You've got the 200-day moving averages coming in right at the bottom of that trading range too. I just wanted to cover that one because that's a big one. Wells Fargo, I think I called that one down as well after earnings, and that's it. So I wanted to give you a kind of an oversight. Citi, I know I called that one down after earnings, and you can see broke down, back tested the trend line, went sideways for a while with like the S&P, and then boom, just in a few days dropped 18%. But where did it close today? You got it right on the 200-day simple moving average. So that let's see if that's done a good job defining the trend on this one. It sure has. So I'm rolling back in time. There's 200-day moving average. This is the first test of it. We were in a bear market. So we peaked back here. This is where we took out both the 200 simple and exponential, and we rallied back. Every time we tried to get above them, we got rejected, kept the bear market going. There was some sloppiness where we were testing them for a while, but this is where we took them back. We were in a bull trend there. We were above them. We were in a bear trend there. We were below them, got rejected on the one and only attempt to rally back. So you can see, again, these are just important levels that both humans and machines tend to buy stocks at, especially when you've got a 20% drop or rally up to them to get there. All right. I could do this over and over because what I'm doing now, I'm getting down to the sectors that don't matter as much. It's all about, and this is the XLI, the industrials. Also very good support. It closed on 200s or just below, but it put in a divergent high. So to me, it's does this go now or later? And all I can tell you, again, this is just another key sector that closed at support today. after a pretty healthy correction. So it's a thread the needle thing, guys. So yeah, I know I might sound confusing because I keep reiterating my longer term targets. I haven't not waffled on those, and I still maintain those. And if anything, I'm even more, convinced they're going to be hit based on the price action over the last few weeks. So it's just a matter of how are we going to get there. And the thing about counter trend rallies in a bear market, especially, like I said, that's why I love trading bear markets. They're just super lucrative because the counter trend rallies, you can go back here and we traded both of these with near impunity back to the 200-day moving average. That was 16.5% on QQQ, the first bear market rally right here in just 3 days. 16.5% right to the 200-day moving average. We had 60-minute charts and everything we're looking at there. Get back short, close the longs out. And then the second bear market rally that came during that trend, the big one, was right here, also right to the 200-day moving averages. Split the uprights between the 200 simple and exponential. You could see it there. It went right between them. 24% in a matter of just about 2 weeks. 24% off there. And so the takeaway and why that's why I spend all the time and effort. And again, if you want to ride those out, if you can do it, great. Keep holding out for the prize. The prize are these longer term targets. You just have to know that along the way, you are not going to get, the stock market is not going to get to my 7th current target. And I'm going to add different. I told you, if we get down there, I'll be adding additional targets. We're not going to go there like this. We're going to go there like this, like the way I've drawn it for a while on my Microsoft weekly chart. I have arrows drawn on this board here. Not to scale, not where each, but just roughly, go down. We're going to hit support levels of these targets. We're going to bounce. We're going to have counter trend. And so, it's not exactly this path, but that's the ultimate path is this uptrend line, the primary uptrend line off the 2009 lows. And Microsoft is really indicative or representative, if you will, of all the other market leading stocks. And so to get there, again, depends if and when we get there. You're talking the stock getting cut in half or more if we get down to that level, which I think we will in the coming year or two. But again, first things first, and then you got the 60-minute charts and all that stuff, potential divergence there on Microsoft and some of the other ones, Apple, positive divergence to today's lows, so that could give us a bounce for the next few days or more. We'll see. I'm going to wrap it up here. And again, this is a 37-minute video showing you multiple things at support, others near support that closed today, and why the odds are elevated, in my opinion, for not just a bounce, maybe even a pretty hefty bounce. But like I said earlier today, the risks are bilateral because when things start to break, when you have such quick movement, with such big drops in important and stocks that everybody's loaded up on, from pension funds to hedge funds to mutual funds to ETFs, people's 401ks, there's a potential that things can break. When a market goes down or a stock goes down slower, it gives more people time to get out of the way, adjust, hedge up. And so that's why you saw the VIX exploding recently, because there was just everybody was one-sided bullish. And like I said, I hadn't seen anything like it in a long time, where risk was not priced into the market. It was not priced in junk bonds. It wasn't priced in credit spreads. Wasn't priced in the VIX, volatility index, but the call ratios, everything that I've gone over. And this is what happens. And this is why I'm sure the majority of bobbleheads on TV are scratching their heads or coming in with some hindsight reasoning why the market's been dropping so much. All right, guys, I'm going to wrap it here. You have the levels to watch. Again, volatility's here, so futures can go up or down overnight, but I'll just keep it simple. I really want to see the lows. I think the lows are in today based on what we hit. And so when you go to the futures, here, I'll find it. This is just a 5-minute chart I was working off of. You got the positive divergence there on the 5. These are the recent lows in the futures. That's what I want to see hold. We go down there, and like I said, they may punch it. This is where the stops are all at right now for those that are long. So if the powers that be can pull it down there, you're going to see a plunge down. If you get even close, you'll probably punch through there and run the stops. You got to figure if you're willing to ride out that much. I'm not. That's going to be a 5.4% drop. So if you bought the lows today or anywhere near there this morning, I want to get those things out to you when those targets were hit. And again, a perfect textbook hit of T5, T6 right there, level given to you the day before we peaked, hit to the button literally within 1 point. I believe that on a 17,352 point index. So low was 17,351. Hit that level, good support level, hammered off it big time to park back right around on T5, which is resistance. And that may be all that bounce is until we go down to the next one. That's what, remember, we hit T4 here, right? Where did we go? We bounced to T2 and then boom, down to the next one. And then we parked there and then we did this last night. Now we bounced here. You know, we're going to zigzag our way down to these targets. This is still T9. That was also laid out on that day. That was my final target. All I did is resequence these since then. I added one target along the way, which I told you, I think it was this one here, one of these. But at this point in time, like I said, I think we could bounce all the way back up here to T2 again. I can easily see that. And that would be a heck of a bounce. Let me just measure it for you if we do. Again, if all this stuff played out, what it's going to take is the markets, things are going to have to stabilize. In other words, nothing can break. Nothing big can break. If anything big breaks, like a major meltdown of any kind of financial institution or broker dealer or fund or something like that, that's going to be 14% if we can rally up that T2 level again. What would be the catalyst? Again, fundamentally, the hopium, the excitement of a 50 basis point rate cut. That's why they were buying it here. That was the bulls' one thing. Overbought didn't matter. Fundamentals didn't matter. Hype on AI didn't matter. Only thing that mattered is the Fed was going to cut rates and the economy was buzzing along. You're going to have the best of both worlds. So now, best case scenario, they're going to be cutting, but mainly because the economy is rolling over. So if we can get that hopium rally, short covering rally, that would be at this point in time. And I'm giving you rough targets, guys. I'm playing this one by the cuff here. That would be, again, at this point in time, a max target. This, what we hit today, minimum target, we already hit it. Again, it's just my levels in reverse. Support, once broken, becomes resistance. And then T4 is going to be a big level too if we get up there. Remember, we've danced on it for several days. We held that level, and it's big resistance. So that one would be, let's just say right now, let me just keep it simple. That would be my minimum target there, and that would be my max. And so that minimum, if it's only T4, what did I just do? I just dragged something away, didn't I? I'll have to fix that line. I hate when I do that. All right, T5 was somewhere around there. Trying to drag the line to fix the measuring. This is the only way to measure on this clunky charting platform here. Hold on. I give up. I can't do it. This charting platform kind of bites as far as moving trend lines around. It just keeps moving everything I grab. I can't grab this trend line here to measure. That's the only quick way to do it. All right, I'm going to stop it here. All right, let's just see where we go. Like I said, this could all be moot by the time you listen to this video. If the futures plunge tonight and take out the lows, and we're going down to the next targets. But as of now, I don't think so. I'll end it here saying the best, one of the most bullish things to see happen would see the futures rip up tonight with a big fat gap up tonight. Why? Why would that? Well, obviously, anytime you go up, that's bullish. But what it would do, it would trap some shorts. All these JCLs. Look, remember I told you a lot of volume coming into SQQQ, the go-to triple leverage. Just as in this day and age, all the investors are out there. Retail traders love this one. It's leveraged up 3 times. It's as much as you can get on an ETF. And you can see the biggest volume. This volume bar eclipses anything we've seen since this thing's been out. This is the biggest volume in history. So a lot of folks buying into this one. And so what would happen in a gap is they're trapped, and then it's 3-time leverage, and they feel a lot of pain. So you'd see a lot of a reversal of this trade. This just shows you a lot of folks been buying the market. Let me see what TQQ has done. TQQ also the biggest volume, potentially capitulation selling on it. right there. And so we'll go back to QQQ. So just, that's how it works. If we do happen to gap up tomorrow, then it's going to most likely trap some short sellers. Here's a level I was watching all day today, but we hit it right at the close. This is a downtrend line. And we need to take this 5-minute trend line out on QQQ. So in the overnight session, if the futures rise up and we gap up above this trend line, the targets I have here, I had one, I don't know where it went. There's yesterday's close, which is the top of the gap. So we gap down. Here's the massive gap today. We backfilled about 2/3 of it. Had a little pullback. Nothing goes up forever. So if we get another leg up, that would be your first target. Again, on a 5-minute chart. But here's the thing. Again, if we hold, then we held the 200. So you can take that quick buck if you want it. Or you can hold out for bigger gains, which I think would be, like I said, I think there's a potential for a double-digit rally in QQQ, 10, 11% possibly, and a lot more than that. And some of the leaders like NVIDIA and the other ones that crowd favorites that are really beat down, a lot of big semis that support, things like that. I told you I'd stop the video 3 times already, and I'm still going. I just want to mention semis too. I told you they're closed SOXX on this price support here about it reversed off that 140 194.77 to close just shy of its 200. And XSD, here's what you look like. Semis obviously took it on the chin, but quite a few of those, if you go through the charts, like NVIDIA at support, Broadcom hammered back, hit the 200. Look at that. And this is why I'm doing this, because this goes into my analysis. The semis are a very important sector. We kissed the 200, bounce, and there's where we closed, right back on. So that was just an intraday break to close back and successfully defend or park on trendline key primary. That's major. Again, this is the October 2022 low up trendline support. So that's the story of, and this is why I do these super long-winded videos, because the more of these market-leading tech stocks and semis closing on support, the greater chance that hedge funds with dry powder that wanted to get in, some that took profits and want to buy back in, individual investors, et cetera, are going to step in and buy. So that's it, guys. I will end it here. This has been Randy Finney with Right Side of the Chart. Have a great day.